Liz Young, so says the president. You're the head of investment at SoFi. You join me now. So the fall of inflation is still very modest. And I guess the idea is whether the corner has been turned or are we just now treading water at the upper limit?
Well, if the corner was peak inflation, I do think the corner has been turned, and peak inflation happened in June of this year. The issue now that you rightly point out is we're still high. 7.1% is still pretty high. And there's a lot of work to be done, especially if the Fed continues to message that they're looking for 2%. That seems very, very far away from where we are, and a lot of work between now and that point.
All right, but if you were to leave rates where they are, wouldn't inflation just eventually come down on its own? Or do they have to become, in your view, considerably more restrictive? I know Chair Powell is talking about more restrictive rates.
Well, it depends on your definition of restrictive. I do think that they need to become tighter than they are now. So today we're sitting at 4% upper bound. We're expecting to see 4.5% after tomorrow's announcement on the upper bound. And the terminal rate, or the rate that we would expect, or the market expects the Fed to stop hiking, is still close to 5%. And that isn't expected to be seen until maybe late spring of 2023. So if we stopped hiking right now, and Chairman Powell has made this very clear, that there's a bigger risk in stopping too soon, a bigger risk in doing too little than in doing maybe a little too much and trying to reverse it later. If we stop too soon and we let inflation stay as high as it is, or even just materially above the target rate of 2%, what you end up with is this increased fear of what's called a wage price spiral, where you have prices that stay high, wages that stay high, and that wage cost eats into the profits of corporations, which, as we know, is really a big part of the American economy.
Do you think it's dawned on people that there is going to be a cut in living standards? Because to take exactly what you say, the wage cycle, well, clearly, to bring inflation down and to avoid the wage cycle spiral, people are going to have to accept less than inflation. And inflation is going to eat into income and savings. Therefore, we are going to see a reduction in living standards over the next few years.
Yeah, I'm suspicious that it already has eaten into living standards at this point. I think that consumers have likely made some choices in order to maintain a standard that they're comfortable with, but it's also going to affect different levels of income in very different ways. And we continue to talk about this high level of savings that everybody has built up. But if you look at where the savings rate is right now, it is at one of the lowest levels that it's been in decades. So people are clearly not saving as much as they were a year ago, but they're continuing to spend. So at some point, either they do have to dip into their savings, or we have a situation where we have high income levels doing most of the saving and having that dry powder, and lower income levels with not much savings left. And that might be seen in the fact that credit card balances have gone up considerably over the last few months. So we could be heading for a little bit of a data awakening as far as the consumer is concerned. And yes, I do think that people are starting to realize that this is going to eat into their income, and it is going to eat into their savings.
Liz, I promise you, in the new year, we will talk about something more cheerful. I know.
I hope so. I hope so. I hope there's something to talk about that's cheerful.
Well, there will be, but we'll talk more cheerful matters. I'm grateful for you. Thank you tonight.